Hey everyone, this is Finding Value. I've talked to a lot of uranium people, and I talked to a lot of people in general in the mining sector. And I think there's one large thing that's missing in the mining sector, and it is having an investment strategy. And I've tailored this to a uranium investment strategy since I know there's a lot of people who like uranium on this channel. Another thing to keep in mind, I'd like to grow this channel, so please subscribe and click the like button, which helps me grow this channel. I'm going to go into a uranium investment strategy, and this is going to be extremely important for everyone to hear. Please share this video if you're interested in uranium or you know other uranium investors, because I think a lot of people are missing it. I am using my mining background and experience through other investments to help everyone here profit from this next bull market that's coming up. So let's jump in. I call it the uranium investment strategy. So there's two ways that mining companies and explorers, discoverers create value. One is where a discovery is made, and two, it's when the discovery goes into production. That's where value is created for investors and shareholders. It's very important to know these two things. In the last bull market, the explorers or discoverers got paid about $10 a pound in the ground for a buyout when spot price was at $100 or more. So figure you're getting a 10% value to spot price when you go to sell a discovery. That's kind of what that valuation was in the previous bull market. So really, the value is created in how many pounds they find in the ground times that 10% value of spot price. On the right-hand side, a company that goes into production, they can either make the discovery themselves or they can buy it in a depressed market for a cheap price, maybe 10% of spot price or something like that. And they're going to go into production and unlock the rest of that value. In the last bull market, if it was $100 per spot, it's the spot price minus the cost to produce whatever that uranium is. So the value on the production side is the value of the find, or how many pounds there is, times the profit of production and reserves, and goes higher as prices go higher. That is considered to be leverage to the price. So on the discovery side, you don't have leverage to the price. You just have whatever the discovery is. On the production side, you have leverage to the price because your profit margin or your earnings per share is leveraged to the price. So if you have a $50 cost producer and the price is $50, they aren't making any money. They're probably not producing and they're barely surviving. When the price goes to $100, you're going from $0 profit to $50 profit per pound. And that 0 to 50 is hypothetically an infinite gain. But let's just say it's a 400, 500, 600 times gain. And that is the leverage in that production price. That's the leverage of profit and earnings per share. And that's what matters to investors, is the earnings per share growth. So now that we understand that value is created on the discovery and value is created in the production side and how that value is unlocked, let's look at the previous bull market to see who performed the best. And those in the sector that both explored and produced what they had found gave investors the highest returns. These types of investments return both explorer returns for the discoveries, and on top of it, they've got the producer returns, which are leveraged to the price, which will give you by far the highest return. So I'm going to go into an example of an explorer. So an explorer is priced at 15 million market cap, and that I think is a pretty good estimate. It's usually 8 million to 20 million-ish market cap for an explorer that's in a good region that could find a lot of pounds in the ground. Let's say this explorer finds 100 million pounds. Let's say the spot price is $100 per pound, and the last bull market paid roughly 10%, and let's say it's $10 per pound in the ground. The total price of this company, if it were to get bought out at a $10 pounds per ground and 100 million pound find, and keep in mind this is 15 million before the find. This is looking at before they found the 100 million pounds. They sell it for $1 billion. Your share price increase or your return as an investor is 66.7 times. So really, the majority of this find is in what they found, which is the reserves, and then it's 10% of whatever the spot price. So you do get some leverage to the spot price. Now, let's go into another example, and this is just off the cuff. It could be even higher than this. So explorer producer, let's say you bought the same company. It's a 15 million market cap. They find 100 million pounds, and let's say the spot price went to $100. We're going to assume that the cost to produce this uranium is $40 a pound. They weren't looking for it before when prices were low, or maybe they found it and they held production for a little bit while, some years, and waited for the spot price to increase. They're making $60 profit per pound of uranium. Let's say the market values this company at $3 billion. That is a profit of 200x. So this one was much higher leverage than the explorer only return, which was 66 or 67. Keep in mind, Paladin Energy did that exact same thing and returned 100,000%. So I'm going to go into some previous commodity examples. And here we go. Endeavor Silver in 2002 was a penny silver stock. Literally, it was a penny per share. They explored and produced silver from their mines. At the top of the boom in 2011, which is only 9 short years, EXK was worth $12 a share, a return of 120,000%. Paladin Energy, the one I just talked about at the beginning of the boom, was a penny a share. And I think it went to $10 a share at the top of the market. 100,000% return. And Southwestern Energy in 2000 was 75 cents a share and went up to a top of $50 in 2008, a 66x increase. So I wanted to give a couple of examples. These are in different sectors. One's in silver, one's in uranium, and the other's in natural gas. If you can find a producer, an explorer and someone who's looking to produce, so they're doing both of these things, they're adding value in 2 areas. They're adding value in the discovery, and they're adding value and leverage to the price of the commodity. So the uranium investment strategy that I propose to most people is you want to find explorers and producers that are valued low, they're increasing pounds in the ground, and have plans to produce those pounds. We need to find companies that will be producing during this bull market in the next 2 to 6 years, is my guess, of when they should start producing. And following up, I will provide an updated list of mining companies that meet these criteria I have mentioned in this presentation. You know, another thing to keep in mind is there are some explorer-only type companies that may also be worth investing in if they're in very fertile ground and areas that have produced, historically with very high grades, which could also return ridiculous amounts during this next bull market. Because if you find a very large deposit, hundreds of millions of pounds, that's going to be a big difference, especially if the price increases. So if you're at a 10 or 15 or even a 40 or 50 million market cap, and you can really push those pounds in the ground, I think it might still be worth putting some money into it. This is Finding Value. Hopefully you enjoyed this clip. If you like these clips, please subscribe and please rate these clips, as it turns on the algorithm in YouTube and pushes these videos higher. Thank you for your time. This is Finding Value.